This is a limited series of the Rational Reminder podcast, a weekly reality check on sensible investing and financial decision-making focused on cryptocurrencies. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 3 in this little mini series on cryptocurrencies. And today we welcomed Professor Eswar Prasad.
Eswar is the author of The Future of Money, How the Digital Revolution is Transforming Currencies and Finance. I found it to be an excellent book. I have listened to it twice and read it once. Skipped around, but still read the text once. It covers the basics of money, banking, finance, how they all work together, but also how crypto fits in and what it could potentially contribute, but also where some of the current iterations of cryptocurrencies like Bitcoin may fall short in Eswar's opinion. The book, we don't in the interview because we covered that in a previous episode. But in the book, Eswar does go into pretty technical details about how the Bitcoin technology works. So if that is something that you want to learn about, I think the book is a good resource for that too.
Mm-hmm. So Eswar is the Senior Professor of Trade Policy and a Professor of Economics at Cornell University, Senior Fellow at Brookings Institution. He's also a Research Associate at the National Bureau of Economic Research. And he's a former head of the IMF China Division, which is pretty cool. He has a PhD from University of Chicago, so of course he fits right in with a lot of the other guests we've had on the podcast.
Yeah. Eswar has previously done a lot of work on emerging markets as well. This is just his most recent book where he's covered cryptocurrencies and money and banking in the type of detail that he did. But in this episode, we talked to Eswar about the functions of money in an economy, what money is, which is always an interesting question, the role and mechanics of banking in an economy, where money comes from. That's another really interesting question. Who creates money, and what are the constraints on money creation? We talked a bit about what constitutes good money, and whether something like a gold standard is a good thing from his perspective. We also did talk about Bitcoin and crypto and DeFi and how they might affect traditional banking. And then, of course, we also talked about the future of money, as the title of his book might suggest we would have talked about.
It's a great conversation. So with that, let's head over to our conversation with Professor Eswar Prasad.
Eswar Prasad, welcome.
Thanks for having me on.
Eswar, what are the functions of money?
So the basic functions are to serve as a unit of account, for denominating transactions, as a medium of exchange for actually conducting those transactions, and then as a store of value, that is to preserve wealth, allow money, allow transactions to take place that allow you to transfer wealth across time and space. So all of these functions are typically tend to get bundled in what we think of as money created by central banks or fiat currencies. But these are the three basic functions that money provides.
Is money a commodity or a social contract?
So at some level, one can think about it as a social contract because a commodity tends to have intrinsic value because of some purpose it serves. But of course, there are commodities that you might think about like gold that do have certain intrinsic value because they have uses, say, in industrial production or perhaps even in tooth fillings. But they have value really as independent stores of value that are far above their intrinsic value. If you think about a fiat currency issued by a central bank, at one level, it is not backed by anything. In the old days, even when governments issued money, they usually backed it with commodities or precious metals. Even during the gold standard period in the US and other advanced economies, the US dollar and other major currencies are backed by gold. But right now, what fiat currency issued by a central bank, like the US dollar, is backed by is just faith and trust in the central bank. But then sitting behind the central bank, of course, is the government, which has the ability to levy taxes and require that the taxes be paid in the fiat currency, which is considered legal tender. So that does give the US dollar or any fiat currency some implicit backing. But again, to a large extent, we use US dollars as money because we know that if we use it in a transaction or if we are to get some US dollars, we can use it to pay for another transaction. So at some level, the fact that all of us believe that the value of the US dollar will be maintained becomes very important in its viability as a money.
So you've mentioned the US dollar a few times. What is outside money?
So there are two concepts of money here. It used to be the case that money that served all of these functions I spoke about earlier as a transactional medium, as a store of value and so on, was created largely by governments. But then there were periods when private merchants were also creating money, and these used to compete with each other. So right now we have money created by central banks because until cryptocurrencies came along, there wasn't much money created by private agents. But it turns out that in modern economies, a lot of money creation or credit creation, which fuels economic activity, is actually created by commercial banks. So every time a commercial bank makes a loan, it creates a corresponding deposit. And that is inside money because it is money that is created by the private sector that trades within the private sector, but it nets out. So if a commercial bank creates a deposit and a loan, then that deposit is the liability of the central bank, but the loan it creates that matches that deposit is an asset of the commercial bank. Outside money is created by the central bank, and outside is literally outside the private sector. So this doesn't cancel out. It is money that is created by the central bank, that is available to the private sector, and that does not net out on the private sector balance sheet.
What constrains the creation of outside money?
That's a good point. If you think about outside money, in principle, there is no constraint other than the fact that if you were to have too much outside money floating around, that would potentially reduce the value of that money. So central bank can go out and, in effect, print a large amount of money. And certainly many central banks around the world, including the Federal Reserve, did that in copious quantities in the aftermath of the financial crisis, when the world and the world's financial systems were craving liquidity, that is basically cheap money, in order to keep the financial systems going. But in a normal world, that would lead to the reduction in the purchasing power of that money, which would get translated into higher inflation, some of which we're already beginning to see. Likewise, if you think about inside money, I argued that a commercial bank can create loans out of thin air, subject to certain regulatory requirements. But remember, banking is a competitive business. If a bank were to go out and create huge amounts of loans, and it provided loans that were not of high quality, in other words, if those loans were not going to get paid back, that bank would run into financial trouble. And of course, the bank needs to make money through the margin between the rate that it charges on loans versus what it pays on deposits. So those commercial considerations constrain the creation of inside money. So both inside and outside money can be created in essentially infinite quantities conceptually, but there are, in fact, in the real world, significant constraints on the creation of both.
Is a mechanically constrained money supply, like a gold standard, a good thing?
Now, you might think that is a good thing. And logically, one might think that the fact that a central bank cannot create money at will help preserve its value. And one of the problems with fiat currency that can be created very easily is that governments have tended to be spendthrift for a long time. So if a government takes in a lot less in revenues than it spends, it needs to make up for that somewhere. Raising taxes is painful, cutting expenditures is painful, but one thing the government can always do is to ask the central bank to print money to pay for that deficit. And that can very quickly erode the value of that money because people start losing trust in that money if there is a sense that the government can spend as much as it wants and the central bank is going to step in. So if the fiat currency issued by central bank was going to be backed by gold, a government has to be disciplined with its taxation and expenditure policies. That is true, but what we have learned over the years is that that severely constrains the ability of a central bank to create money when it is most needed. That is, at times of great financial and economic peril, of the sorts we've experienced a couple of times in the last 15, 20 years, and even before that, the central bank's ability to create a lot of liquidity, that is essentially money, to lubricate the financial system becomes very important. This is why the US and the other advanced economies ditched the gold standard, because it was taking away autonomy from the monetary authorities to do what they needed to do to support the economy and the financial system.
So do commercial banks need to take in deposits to make loans, like the fractional reserve banking idea that I think many people are familiar with?
So it turns out again that this is not quite the way modern banking works. There is an element of truth to it. Certainly, banks can also passively accept deposits and make loans based on that. And it is true that banks cannot exactly match their loans with their assets. They need to maintain some amount of capital. Capital is basically the financing that is generated by a commercial bank when it issues equity to equity holders. So what happens is that equity actually provides a buffer. Let's say a bank has made a lot of loans and has deposits on the liability side of its balance sheet. If some of those loans turn out to be bad, especially in bad economic times, such as an economic recession, when households are not able to pay back their mortgages easily, when firms cannot pay back their loans easily, if the commercial bank came under financial threat, there would be a problem, because then you might have depositors who are clamoring to get their money back. So the capital that a commercial bank holds provides a loss buffer. In other words, even if some of the loans don't get paid back, then the holders of equity in that bank essentially are the ones who are going to take some of the hit. Now, this is exactly why commercial banks don't like holding a lot of capital, because it turns out it's more expensive for them to raise financing by issuing equity, because it dilutes the ownership shares of those who already are the owners of the equity stakes in that bank. And it is much more expensive than raising money through deposits. But again, we are in a world right now where the traditional notion of banks taking deposits, putting some of it in the central bank and then lending out the rest, that's not quite the way modern banking works.
Can you explain what fungibility is?
So fungibility can mean a variety of things. If you think about different concepts of money, then there is the notion of fungibility, essentially implying that commercial bank money and fiat currencies trade at par. Now, when a country or a country's central bank issues money, that fiat currency essentially trades at par with commercial bank deposits. And that one-to-one matching essentially means that inside and outside money, money created by commercial banks and by the central banks are essentially substitutable for one another. Although one important distinction is that the money created by the central bank is a liability of the central bank. Money created by the commercial bank is a liability of the commercial bank. But because there are regulatory constraints in place to make sure that banks don't go crazy creating their own money, that parity between the two types of money can be maintained, which makes them fungible.
So do commercial banks lend out reserves, the outside money, to retail customers?
So reserves are usually maintained at the central bank, and that's usually for settlement of transactions among banks. So if you and I were to conduct a transaction, let's say I wanted to send you some money, and we are not with the same bank, then money has to travel from my bank account to your bank account. And that happens through a netting of various transactions that may take place. Maybe there are some people who are customers of your bank who want to send money to people who have accounts at my bank. So all of this gets netted out, and the net transactions are settled either through a payment system that is managed by the banks themselves, or in many cases for large value payments, it is a payment system that is managed by the Fed. So actually, reserves are held by commercial banks and the Fed to meet those requirements. And of course, the Fed can also provide liquidity when needed. But typically, you don't think about the reserves being lent out directly, but it is true that a central bank can basically create more reserves, which basically makes it easier for a commercial bank to generate inside money.
So we talked about fungibility a minute ago. How is physical cash different from electronic money in a commercial bank account?
That's a good point. These two trade at par, and you might think that there is some fundamental difference between the two. And in fact, many central banks are thinking about issuing digital versions of their own currency. So we might have three things at play here. One is physical currency issued by central bank, digital currency issued by central bank, which is still a liability of the central bank, and then bank deposits. So you could have digital versions of the fiat currency, perhaps digital dollars, which maybe we'll come to talking about in more detail as we go along. Those are going to trade at par with bank deposits. So at a conceptual level, there is no difference between a bank deposit, which you can use for payments, or physical currency, which you can use for payments, or if we eventually come to a world where we have digital versions of the dollar, it will be very similar. So the way in which we conduct our payment transactions, the consumer business or consumer to consumer interfaces may look a little different, but conceptually, these all amount to essentially the same thing when it comes to making payments.
What about anonymity of different
That's
payments?
a very important issue. Cash has certain attributes that make it very attractive. So cash does provide anonymity. It provides immediate finality of payment transactions and those settlement. In other words, when I walk into a coffee shop with a $10 bill, pay for my extra large mocha frappuccino, not that I actually drink those. If I want to pay using a $10 bill, that goes into the cashier's till. And there is immediate settlement without the coffee barista having to know anything about me. But if I were to make that payment using a bank account or using, say, Apple Pay or Google Pay that I can use my phone for, the barista may not know who I am, but ultimately there is going to be some trace of it, a digital trace in the payment system. That means that ultimately the person making that transaction is not going to be anonymous anymore, because anything digital ultimately leaves a trace in terms of financial activity. But of course, the fact that cash payments are anonymous has implied that cash can be used to finance illicit transactions of various sorts, can also be used for perfectly legitimate transactions, but ones that don't get reported to the tax authority. So, of course, if I was to pay, somebody working in my garden for a couple of hours, the kids who shovel snow off my sidewalk, or a babysitter in cash, and that doesn't get reported to the government, that's not a big deal. But if you think about more high-value transactions being intermediated in cash, that could potentially mean that there is a lot of activity taking place in the shadows. And the shadow economy does have implications for the government's ability to raise taxes. This is not a huge concern in a country like the US, but in many countries around the world, the shadow economy fueled by cash transactions is really a big deal. And the anonymity of cash is a key feature of cash that enables that.
What are the main functions of the financial system?
So financial system plays certain critical roles. One role, of course, is providing capital for entrepreneurs who may want to, undertake business activities. It provides loans for people who want to build houses. So essentially, it allows us to borrow against future streams of income. Financial systems also allow us to save for the future in the form of pensions, in the form of savings that we might undertake to get a down payment ready for a house, and basically to transfer consumption from the present to the future. So financial system basically allows for intertemporal aspects of managing your finances. If you're a young student, you might want to borrow some of your future earnings. If you're making a lot of money now, you may want to put some of it away. So savings and intermediating those savings into productive investments is one key function. But in addition, financial systems also play important roles in terms of managing risk. If you think about insurance products, in terms of having access to a variety of diversification opportunities, which not only allow you to accumulate and build wealth, but also to make sure that you don't lose that wealth if, say, one company that you invest in or one country that you invest in were to go down the tubes. You want to make sure that you have the ability to diversify. So managing volatility and risk is another important function. And then, of course, there is the payments function, making sure that an economy can work well in terms of meeting the ability of consumers and businesses to match their needs. Likewise, to enable payments between consumers and between businesses themselves. So financial system ends up playing a pretty big role in terms of allowing modern economies to function smoothly.
And what is shadow banking?
So shadow banking is this a term that has this very shady connotation clearly, but it is meant to imply the entire part of the financial system that is not that does not come under the rubric of traditional commercial banks. And shadow banks, can come in various guises. One can think of certain high-end financial players such as hedge funds, private equity ventures, which allow high net worth individuals to find interesting investment opportunities. There are also other aspects of shadow banking. So if you think about, a pawn shop or a money lender, we don't have too many of those in the US anymore, but those could be considered shadow banks because essentially they're providing some of the same services as banks. Maybe saving instruments, maybe the ability to cash your paycheck without having a bank account, maybe get loans by pawning some of your tangible assets. So there is a vast number of institutions that come under this rubric of shadow banking. Now, the regulation of these institutions tends to be slightly lighter than that of commercial banks. And commercial banks play a critical role in modern economies. As I mentioned, they are very important in the creation of money. So they tend to be much more tightly regulated. But there is a whole set of other financial services providers that also play an important role in the economy and that come under this rubric. And they tend to be slightly, and in some cases, much less tightly regulated than the commercial banks.
How is trust facilitated in the financial system?
Trust is a key underpinning of a financial system. When you use currency or cash for a transaction, you don't need to trust the person who's giving you that money. All you need to have is trust in that money. So in other words, so long as you're not worried about counterfeit $20 bills, if somebody gives you a $20 bill, you can have a reasonable amount of faith that actually represents $20. But then if we move to a world where you don't have physical currency available, and that physical currency, implicitly has trust in either a central bank and or the government that stands behind that central bank embedded in it. But then if we want to undertake electronic transactions, we need to find a way to have an institution that is going to intermediate those transactions. And this is where commercial banks, credit card providers, other payment services providers basically create institutional trust. So in other words, when I go into a a coffee shop and pay. In this instance, with my credit card, the person who's giving me the cup of coffee knows that eventually the credit card company will make sure that they collect the money from me and pay the coffee shop what it is owed. So there is faith in the credit card company. Likewise, if you think about most commercial transactions, buying a house, there has to be an exchange of the title for the house, but also an exchange of money. And you want to make sure that the person who's buying the house doesn't run away with the title without providing the money. You want to make sure that the correct title is provided. So we have settlement attorneys, essentially trusted third-party intermediaries. So these third-party intermediaries who are backed up by an institutional framework, because after all, even settlement attorneys and credit card companies have to play by the rules created by the government. So it's an intricate system of trust that involves trusted institutions, but behind that, an institutional framework, including a legal framework that is very important in order to maintain the trust that is necessary to make modern economies work well.
Do you think that the financial system can be disintermediated by technology?
That's a very interesting question, and one that financial services providers, including commercial banks, are having to grapple with. So there are many fintech lending platforms out there. So fintech is just a fancy term for new financial technologies. And of course, financial innovation is nothing new. The creation of money was a financial innovation. The appearance of ATMs was a financial innovation. But there is something fundamentally different about this new wave of financial innovation that is encapsulated by this term fintech. And that is the appearance of digital technologies. That is transformative in a couple of ways. First, it means that the costs of entry for new financial services providers are much lower because you have to set up an internet platform, but then you don't need brick and mortar branches. And second, it's very easy to scale up these platforms because once the platform is there, when you add an extra user, the marginal cost of servicing that user is essentially zero, unlike a brick and mortar branch where, again, you have to pay for the people who are going to be sitting in that branch, who are going to provide teller functions and so on. So that is transformative in one very important way. And what this has enabled is the direct connection between savers and borrowers. So right now, there are platforms out there where if you have an interesting business project, you can go out and Kickstarter or even GoFundMe and say, hey, world, I have this great project. I need money. And a saver can potentially say, this looks like an interesting project, either out of the goodness of my heart or because I believe that I can get a good return by investing in this. I can go out and invest and I don't need a trusted third-party intermediary. Now, do we really know the bona fides of the person who's asking for that money? Are they legitimate? Do they have a legitimate business purpose? It's not clear. That's the function that commercial banks have very effectively provided, essentially the screening of borrowers. But it looks like these fintech platforms are actually getting at least limited traction. Plus, of course, you have internet banks, neobanks, challenger banks that are undercutting the very basic business model of commercial banks. So I think there is a lot of change coming in terms of financial markets and institutions, and the ability of these fintech platforms to scale up to the extent that they rival traditional institutions is the one question mark out there. But over time, we are seeing that they are getting a lot of traction.
Now, are intermediaries necessarily a bad thing in an economy?
Intermediaries actually play a very useful function. There are two key issues which a commercial bank is much better at sorting out than other institutions, and this is why they've been around for a long time. One is maturity transformation. If you think about putting money in a bank account, you want to be able to withdraw it essentially at any time. So deposits are inherently short-term. On the other hand, the loans which sit on the asset side of a commercial bank's balance sheet, those are longer term. If you're building a house or building a firm, that takes a while. So the loans are essentially not going to be repayable in the short term. So how do you match the short-term liabilities of the commercial bank with the longer-term loans or assets of the commercial bank. So that maturity transformation, taking today's money, converting it into something that is usable for a productive purpose and that's going to get paid back over the long term, that's a key function. Another function is related to information asymmetries. The idea that basically borrowers know a lot more about themselves than anybody else does. So this basically comes down to evaluating the creditworthiness of a borrower and his or her business idea. The notion that banks have become much better at this, if you think about small community banks, they have relationships with the people in the community, and that gives them a sense of whether when they make a loan, this person is trustworthy, is likely to be able to pay it back. Of course, even the most trustworthy of persons with the best business idea might flounder because, you might get hit by a pandemic that forces you to close down a restaurant that was a great concept. So banks take on that risk as well. So financial intermediaries such as commercial banks actually do serve very important roles in modern economies. And there is a question about whether fintech platforms can actually substitute for these functions. And in some cases, they're able to do so. There are many payment platforms in China, for instance, that are hoovering up data on what sort of purchases their consumers are making, when they pay for those purchases. They also have information on the cash flow of merchants selling products on their payment platforms. And this allows them to aggregate up their information into credit scoring that actually has turned out to be much more efficient and accurate than credit scoring based on traditional models. So even in terms of the core functions of financial intermediaries such as commercial banks, it's possible that technology might lead us into much better opportunities.
Interesting. I want to shift gears a little bit now toward the future of money, the title of your book. Digital cash, that concept goes back to 1983 from what I could find. Proof of work goes back to 95 and 2002. Blockchain in 1991. So these are all things that people hear about with respect to Bitcoin. What was Satoshi Nakamoto's 2008 innovation?
So actually, proof of work was devised by one of my Cornell colleagues in a 1999 paper. His name is Ari Jules. And if you think about Bitcoin and its use of some of these building blocks, it's quite ingenious. So let's think about what Bitcoin, which is the original cryptocurrency, was meant to solve. It was essentially meant to solve the following problem, that you wanted to create a medium of exchange that did not require the use of a trusted third-party intermediary, such as a commercial bank or credit card company, or the use of an official currency, such as cash, and to be able to allow these transactions to be conducted using just the digital identities of transacting parties, sort of just like using account numbers that are anonymized without any password information directly attached to them or being revealed. Now, the timing of Bitcoin's advent is really important. So the Bitcoin white paper was released in late October of 2008. This is about 6 weeks after the so-called Lehman moment in the US. That was the day, September 15, 2008, when the iconic investment banking firm Lehman Brothers went under and looked like it might take down the entire US and perhaps even the global financial system down with it. So at the time, trust in governments, in central banks, in traditional commercial and investment banks was really at an all-time low. So this was a very appealing proposition that sort of resonated with the libertarian zeitgeist of the time. So if you think about what Bitcoin was trying to do, at some level, it sounds astonishing and really remarkable. How on earth, if I didn't know who I was transacting with, how could I possibly conduct a transaction, make sure that in fact the transaction would be completed? And since this is digital money, how would one make sure that those units of digital money could not be respent? Because after all, if it's all digital, you could just keep spending the same unit of currency again and again. Now, it turns out that Bitcoin came up with a phenomenal way of solving this. And some of these building blocks that you mentioned, distributed ledger technology, proof of work, were all important building blocks. And there were some cryptographic tools involved as well. But what is remarkable about Bitcoin is what I would consider radical transparency. So in other words, distributed ledgers are essentially public ledgers of record of transactions. And what Bitcoin does is basically post every transaction ever undertaken using Bitcoin and the transacting parties' digital identities, and post them on these digital ledgers that are visible for the entire world to see, and maintained on multiple computers around the world, which are synchronized in real time. So this is where the security and resiliency of the system comes from. The fact that it is a distributed network where if somebody tried to tamper with one or even a few electronic ledgers, that would be quickly detected and rejected by the system. But you still need to validate transactions. This is where the proof of work becomes important. It turns out that what the Bitcoin algorithm does is throw out a numerical puzzle that can be solved only using brute computer force. Essentially, you have to guess a solution. You cannot solve the problem using any cool analytical methods. So the more computing power you have, the more likely you are to solve this problem. And the first computer to solve this problem gets the privilege of validating a block of transactions. So that block of transactions, once it is validated, is then linked using computer code to all the previously existing validated blocks of transactions. Hence the term blockchain. And the blockchain, it turns out, is very secure because in order to override these transactions and to sort of create a new history of transactions, you would need to devote an enormous amount of computing power. That is, you would have to prove that you created even more work than already exists on the blockchain. So that's where the security of the blockchain comes from. And at some level, it is a truly remarkable innovation. Unfortunately, it turns out that Bitcoin is terrible at what it was supposed to do. It's got very volatile value, so it's not a good medium of exchange. It turns out it's not anonymous as had been thought. It turns out that it's not very efficient in managing transactions because it turns out that on the Bitcoin blockchain, you can validate only about 6 to 7 transactions per second compared to hundreds of thousands or millions on the Visa or MasterCard network. And it takes about 10 minutes for the transactions to be validated. Your cup of coffee would cool down before you could buy it using Bitcoin. But the technology that it has given us, blockchain technology, I think is going to be the real lasting legacy of Bitcoin.
Is Bitcoin truly decentralized?
It is decentralized in the following 3 senses. It is a decentralized architecture, which essentially means that you don't have one computer managed by one institution that is maintaining the public digital record. It is distributed across a large number of computer nodes around the world. There is a decentralized consensus mechanism, as I just described. There is no single party that is authorized to validate transactions. This takes place through this approach that is in turn based on proof of work. But in addition, there is decentralized governance. That is, there is no single agency that is running Bitcoin. Right now, it is just running on its own using this algorithm that is created by whoever the creator of Bitcoin was. It turns out that some of these parameters, how many Bitcoins will ever be created, how many transactions can be fitted into a particular block, these can all in principle be changed if the entire community agrees upon it. So these 3 elements, decentralized architectures, decentralized consensus, and decentralized governance, are all underpinning a new movement that is called decentralized finance. But Bitcoin is the initial version of decentralized finance. Now, of course, Bitcoin can be traded on centralized exchanges. You can go to your, Bitcoin ATM and through your bank account convert your US dollars into Bitcoin. So you might think of that as being centralized to some extent, but at its core, Bitcoin is truly decentralized.
Do things like the concentration of mining power and ASICs, do those affect the decentralization of Bitcoin?
Now, one could argue that if you created enough of a concentration of computing power that would essentially allow you to override the other members of the community. So in principle, if you owned 51% of the overall computing power that is dedicated to Bitcoin mining, which is this process of validation of transactions I referred to earlier, you could override the system. But there is a strong self-incentive of people who've already accumulated Bitcoin to keep the system from melting down, because once trust in the system is lost, all the money that you notionally have in terms of your Bitcoin holdings would be lost. There used to be a concern even a year ago that the concentration of mining power in China could mean that the Chinese government could basically run away with a lot of Bitcoin. But here again, the self-interest of Bitcoin miners comes into play here, because if you start running away with Bitcoin, people lose faith in Bitcoin, the value plunges to zero in no time at all. ASICs are interesting, and there is a different aspect to all of this related to ASICs. So ASICs are essentially specialized devices that are used for cryptocurrency mining. You can do cryptocurrency mining even using your garden variety laptop, but it's sort of like buying one lottery ticket. You might get lucky and be the one to guess the solution to the problem that the Bitcoin network throws up, but the probability is very small. If you have a massive amount of computing power and you have specialized devices dedicated to basically generating these guesses, it's likelier that you will be the one to first solve this numerical puzzle and therefore to get the reward in terms of Bitcoin. But the problem here is that given the price of Bitcoin, the financial incentives to mine Bitcoin and the competitive element mean that there is an enormous amount of computing power devoted to this sort of cryptocurrency mining, which means you need energy, electricity to run the computers, to cool them. And because these ASICs have no other purpose other than for cryptocurrency mining, and because they are run essentially non-stop 24/7, they burn out very quickly. So you create a lot of computer detritus as well. So this proof of work mechanism that is used to validate transactions on the Bitcoin blockchain is at some level a conceptual marvel, but it has created a huge environmental problem for the world at large, with, by some estimates, the Bitcoin and cryptocurrency mining operations consuming between 0.5% to 1% of worldwide electricity consumption. It really is an environmental disaster.
Wow.
Are public blockchains immutable?
So in principle, yes. I mean, once you set up a blockchain, it becomes very difficult to alter that blockchain. But what sort of consensus mechanisms are used to validate transactions on the blockchain becomes very important here. I spoke about proof of work and how it is conceptually marvelous, but a disaster in terms of efficiency in the environment, has led to a search for other consensus protocol. There is one called proof of stake, for instance, which is not as computationally intensive, is much more scalable in terms of being able to validate a lot of transactions relatively quickly. The second largest cryptocurrency by market capitalization, Ethereum, is in the process of moving to this new consensus mechanism. So that is going to make blockchains built on that consensus mechanism much more efficient. But there are some questions out there in the cryptography community about whether proof of stake is as secure as proof of work. Some of my colleagues at Cornell University are working hard on precisely these sorts of questions. So public blockchains that are built on proof of work have typically turned out to be quite secure, especially the more mature blockchains. If these are shorter blockchains, of new cryptocurrencies that have just come up, where there is not that much computing power devoted to them yet, you could imagine malevolent actors very quickly accumulating computing power that allows them to override the network. But again, that would be self-defeating, because if people don't trust your cryptocurrency, it's never going to get much traction. You can also have blockchains that have different kinds of read and write permissions. You could have a blockchain that is visible to everybody, but where the right permission of writing transactions or changing them is with a centralized authority. So there is talk, for instance, about using blockchain technology to provide land registries, say in India, in a manner that is easily visible, that can be very easily updated, but all the updating is done by a government authority. The blockchain simply becomes a mechanism through which everybody has very easy access to a set of public records that they can trust.
Why do you think Bitcoin and other cryptocurrencies have value?
That is an intriguing question. As I just argued, Bitcoin is not working well in terms of the purpose it was designed for. So it really has no intrinsic value. There are other cryptocurrencies like Ethereum, which could end up having value, because the Ethereum blockchain, once it moves to proof of stake, could provide for a lot of new products such as smart contracts, flash loans, and so on, which are very cool products that can be built and executed on the Ethereum blockchain. Bitcoin devotees will tell you that there is one fundamental proposition underlying Bitcoin's value, which is that of scarcity. There is a hard cap built into the algorithm, which states that there are only 21 million Bitcoins that can ever be created. About 19 million of those have been created so far, so there are about 2 million to go. So the notion of Bitcoin devotees seems to be, this is scarce, even though it is digital. On the other hand, a fiat currency like the US dollar can be printed at will. And during the global financial crisis, during the initial period of the COVID pandemic, the Fed went out and printed huge amounts of money. So surely something that can be printed in essentially infinite quantities is going to lose value relative to something that is scarce. To me, that is a dubious proposition. Just because something is scarce, it's not obvious that it should have value. So ultimately, the value of Bitcoin seems to rely on what came to be known during the lead up to the global financial crisis as the greater fool theory, that you could buy a house even if the price seemed insanely high, because you thought that all you needed to do was find one fool greater than yourself who'd be willing to pay a higher price for that house, and you'd be okay. Some of that faith in Bitcoin seems to underlie its value as well. And I think there are lots of retail investors who, again, get taken in by the razzle-dazzle of the new technology, who see their neighbors, friends, kids making seeming fortunes by buying Bitcoin or Dogecoin, and they don't want to miss out. So the fear of missing out may be another aspect. But I view the notion of something like Bitcoin becoming a financial asset as one that is built largely on speculation, and I worry that it's not going to end well.
You mentioned some of the uses of Ethereum. What gets better with decentralized monetary and financial systems compared to the existing system?
So decentralized finance does have some appealing features to it. One is that you don't have the legacy institutions that can essentially outcompete new entrants. If you wanted to go out and set up a bank because you felt you could provide services much more efficiently, it's actually very difficult getting a banking license. It's also difficult to get around the regulatory aspects. So you need to set up a big compliance department. You need to hire a lot of people just to deal with the regulatory aspects. So it becomes very difficult for new entrants. It becomes difficult to introduce new products and services. But if everything is done in a decentralized fashion, it makes it very easy to do all of this. You can provide a product on a blockchain, and depending on how persuasive your product's pitch is and the services it provides, you could have decentralized finance becoming an alternative to the traditional banking system. There is also the sense that you could create a democratization of finance. Right now, if you are the sort of person who keeps $1 million in the bank is very happy to serve you. If you walk into the bank and say, I'd like to start an account with $25 and I'm probably going to put $1 or $2 there every month, the bank is not interested in you because the cost of servicing you are just too high. If you have a few $1,000s to invest and you walk into an investment manager's office and saying, please help me figure out what to do with this, unless you have, a few hundreds of $1,000s to begin with, they're not going to spend their time on you. But with decentralized finance, you could offer basic banking products for credit, for insurance, for savings at scale with very low fees and provide very widespread access. You could even provide bespoke, that is carefully tailored financial products and services, even to low net worth individuals and households. So there is the prospect that decentralized finance could, in fact, democratize finance in many of these ways. There are also exciting new products being created on decentralized finance, built on decentralized blockchains. For instance, it turns out that you can conduct transactions using smart contracts. Going back to this notion of using a trusted intermediary, such as a settlement attorney for a real estate transaction, if you can tokenize the ownership of your house, post it on a blockchain, tokenize money and put it on a blockchain, both of which are feasible already, you can conduct transactions that securely swap out one financial asset for another, or one financial asset, or even real assets such as money or a house or a car for another. So there are possibilities that are opened up by decentralized finance, which really could create lots of innovations in terms of even basic banking and other financial services.
Are there downsides to decentralized finance?
Yes, as with anything, I think the notion that technology will solve all problems might be a bit of a mirage. Certainly, there are technological vulnerabilities out there. I should say that when you hear about things like smart contracts, the notion, of conducting transactions involving large amounts of money without any trusted intermediaries being involved and doing this in an anonymous form, sounds like it's a recipe for failure. It actually works quite well. It's more secure than you might think. But there are problems still. There are technological vulnerabilities. And even though the community can fix the open source code very quickly to take care of these vulnerabilities, sometimes very sophisticated hackers, and you need really a tremendous degree of sophistication to get around these technological protocols. It turns out there are some technological vulnerabilities. And then there are other kinds of problems. It's all very well to say that decentralized governance, governance by the community is a wonderful thing to have. But if there are problems with a particular protocol, if there are concerns that a particular group is trying very hard and potentially at risk of taking over the governance of a technological protocol, there is no authority that you can appeal to avoid that outcome. Plus, blockchains are, closed ecosystems. So if you want to trade products on the blockchain, let's say a futures contract, you need prices of the underlying commodity or underlying asset, and you need to use what are called price oracles that essentially allow for communication between on-chain or on that blockchain products or services with off-chain, that is regular financial system prices and protocols and so on. And those oracles, again, are becoming quite secure, but there are some vulnerabilities there as well. So there are technological vulnerabilities, potentially some financial vulnerabilities, but in addition, governance issues. What is amazing to me is how far decentralized finance has already gone. Even though you might think that all of these are deal breakers, it would allow it to never get off the ground. And the community behind this seems to be working very hard to fix at least some of these problems. But issues like the decentralized governance are not going to be easy to fix.
So it doesn't eliminate the need for trust is kind of what I'm hearing.
That's correct. Ultimately, trust is going to be very important. And the question becomes, what do you place your trust in? Is it in the government? Is it in a financial institution, which in turn is backed by the government? Or in essentially computer code that is managed and maintained by a community? The notion of people's power is all very well, and it is quite powerful in terms of how well it is being executed so far. But I think that even with these mechanisms, you are going to need governments to play a role. You can think about tokenizing a house, tokenizing your money, exchanging them for one another. So in fact, for all practical purposes, the ownership of, let's say, your house gets transferred to me. But if I then show up at your door and you and your family are still living in the house, who's going to, move you out of the house? You need an authority such as the government to make sure that property and contractual rights are properly enforced. So I don't think even with decentralized finance, we're going to be able to get away from needing an authority that you can place your ultimate trust in, which might be the government.
So could unofficial digital currencies affect the ability of central banks to implement monetary policy?
It could create some complications. There are decentralized cryptocurrencies like Bitcoin that are not backed by anything. And like I said, they're not working well as mediums of exchange. That has led to the creation of new cryptocurrencies called stable coins, which get their value, ironically enough, by being backed up by reserves of fiat currencies. And these could work efficiently as payment mechanisms. So if you have companies like, say, Amazon or Facebook, which abandoned the stablecoin project recently, but might revive it at some point, if you have stable coins floating around, that could create some complications. But more importantly, if you have commercial banks becoming less important in the financial system as a consequence of these new technological developments, that creates a real risk because commercial banks are very important not only in the creation of money, but in the transmission of monetary policy. Right now, when the central bank changes interest rates, it usually changes interest rates on the very short-term costs of borrowing for commercial banks. That then gets affected in their deposit and lending rates, that then gets transmitted to the things the central bank cares about, which is economic activities such as GDP, employment growth, unemployment, and also inflation. If banks become less important, if fintech platforms start playing a bigger role in financial systems, we have no idea really whether they will be sensitive to changes in central bank interest rates. So the implementation and transmission of monetary policy could become a whole lot more complicated than it already is.
Interesting. One more question for you, Eswar. The Federal Reserve Bank of Boston and MIT, they've come out with a central bank digital currency paper, Project Hamilton. They did not use blockchain, from what I understand. They said it didn't meet the goals of their project. Does Satoshi's innovation have anything to do with the development of central bank digital currency?
It's had one important role, which is it has catalyzed central banks into thinking about digital versions of their own currencies, because the reality is that cash is fast disappearing in countries like China and Sweden. It's already at a level where it is barely used in retail transactions. Even in many other developing countries and advanced economies such as the US, where we still use cash to a significant extent, the use of cash is disappearing. So I think this was inevitable that central banks would start thinking about issuing digital versions of their currencies. But the appearance of cryptocurrencies, the appearance of stable coins has really lit a fire under central banks to start thinking about CBDCs. But for reasons I mentioned earlier, the blockchain technology is hopelessly inefficient in terms of being scaled up to manage a large volume of retail transactions. So the technology underlying CBDCs is going to be quite different from that underlying cryptocurrencies. But the emergence of cryptocurrencies, I think, has played a pretty important role in getting central banks moving more quickly in this area than they otherwise would.
Very interesting. All right, Eswar Prasad, that's our last question for you. We really appreciate you joining us on the podcast.
It's been my pleasure. It was a great discussion. I had a lot of fun, and I hope your listeners enjoyed it as well. Thank you so much for having me on.
Yeah, thanks, Eswar.